Well, let's put the spotlight on private equity and VC investing. With global uncertainties and fears of inflation on the rise, what are some of the top themes for 2023? Abhishek Sharman is the founder and managing director at Carpediem Capital, a homegrown private equity fund, and he now joins in on the show to discuss the outlook ahead. Abhishek, thanks so much for taking time out and being with us. To begin with, I understand that you've said that we are going to see, sustainable cash flow generating businesses be at a premium, and that we are going to see a lot more aggressive PE investing now. Can you elaborate a little bit more?
Yeah, first of all, thanks, Avanne. Great to be here. And as I said earlier as well, that private equity capital is not is not in any scarce quantity. I mean, people talk about the funding winter, so to say, but there is abundant amount of capital that private equity funds have raised. People are sitting on vast pools of undeployed capital, looking for good opportunities. I think one of the things which was leading to I would say subdued levels of deal activity from a private equity standpoint. Obviously, there was a lot of capital being deployed on the venture capital side, but from a private equity standpoint, there was subdued activity because people could not get comfortable with the valuations. People could not get comfortable uh, with the kind of business plans that were being sort of created for businesses, typically involving a lot of upfront burn and cash flows and concomitant profits coming a few years down the line. Thankfully, a lot of that rationality, which was missing, is now coming to the fore. I think by and large, today companies are being sort of rational about how they want to allocate capital. There is also a desire to transact because there is a real need for capital, because there's been somewhat less capital availability over the last 9 to 12 months. As a result of that, I think a combination of better sort of I would say more rational projections, as well as I think the valuation levels correcting significantly. Private equity activity is, in my view, likely to be very aggressive. We ourselves are looking at, as we speak, about 4 deals, which is a lot for us. And I believe that the situation is similar at many other private equity oriented firms.
So, Abhishek, in light of that, walk us through, the top 3, 4, or 5 themes that you think are really going to flourish in 2023 by way of PE investment.
I think private equity, because we sort of invest for the medium term, I would say, 4 to 7 years. I don't think the themes change very much on an annual basis. But in an environment like today, I would say that consumer, particularly consumer discretionary, continues to be a very, very strong area of interest. We have seen over the last decade or so multi-billion-dollar categories getting created in discretionary segments. I mean, Domino's Pizza is an example, Page Industries, which sells jockey innerwear, is an example. So many such categories are getting created, and they continue to be at the forefront of private equity focus as far as India is concerned. I think that will continue to be the case. So I would say category leaders in discretionary consumer segments, they're going to be very, very sought after. Financial services, particularly consumer focused financial services, is going to continue to be a very strong area of focus. India long term is going to see a very strong offtake in credit, and we are still far away from that point where those who need credit at rational levels of interest are getting it. So I think we see that as an area of continued focus. We also believe that healthcare services are something that will require intervention from the private equity side. India's healthcare ratio to GDP is abysmally low. I mean, US is 18% of GDP is healthcare. 10% of GDP in Europe and UK is healthcare. India is at 3-4% levels. There is a strong structural need. The requirements have come to the fore even more during the COVID period. So I think healthcare, and in particular, accretive high return capital models of healthcare, particularly single specialty healthcare, we think is going to be an area of strong focus. Apart from that, I think on the managed services side, we see some very interesting opportunities. We invested in a business of that nature called Yantra, which was into mobile repair refurbishment services. We sold that business to Walmart earlier this year. We are seeing a lot of new businesses in the services segment, which are going to be attractive, going to scale up very, very aggressively in the times to come. Just to give you a data point, business services typically tends to be 8 to 10% of the GDP of a country. In India, that number is at 2 to 3%. So business services will again be an area of strong focus. Manpower staffing in general, given the kind of workforce accretion that India is seeing, as well as salary growth. So I think these, to my mind, are areas of significant focus for us and for should be for most of the private funds.
So, Abhishek, walk us through some of the recent investments made, and for those who aren't aware as well, for Carpediem, which are some of the companies in India that you have long-term investments in?
So we are currently investing out of a second fund. Our first fund we invested between 2016 and 20. We had a portfolio of 8 companies from Fund 1, including a biryani chain called Biryani Blues, which continues to do very well, particularly in NCR, where it is first among a lot of players. We have a ketchups and sauces company called Adinath Agro, which sells India's largest Jain sauces called Surabhi. We invested in a company called Yantra, which is sold to Walmart, which was the leader in mobile repair and refurbishment services. We also invest in areas like value retail, where we have a company called Nyasa Retail, which operates under the brand name of One India Family Mart. We have a design and build services company called Flip Spaces. We have a healthcare portfolio company called Collateral Medical. And we have a fashion jewelry company called Sukhi, which is probably India's largest selling online fashion jewelry company. So resonating with the same themes in terms of companies which are trying to create a consumer brand or companies trying to create an organized service. We are investing from Fund 2. We have made 2 investments so far. We have invested in a company called Sindhuja Microfinance, which operates in areas like Bihar, Eastern UP, Rajasthan, Madhya Pradesh, Jharkhand. There's a company which has now grown to more than 600 crores of loan book and has probably India's highest percentage of cashless collections. 85% of collections are through online and Aadhaar-enabled UPI payment systems. So that's our first investment from Fund 2. We have also invested in a company called Fornax Manpower Solutions, which we believe is going to emerge as one of the leading players in the manpower services space in India. The manpower services space in India, which has got a couple of listed players, companies like Quest and TeamLease, but is an area which is going to see a resounding amount of growth, we believe, given the fact that India is going to become in the next decade the world's largest workforce. And therefore, much like IT services saw the emergence of more than $25-30 billion companies, we think that India is going to have a large number of manpower services companies. So we have invested in a company called Fornax Manpower Solutions, where we partnered a very, very senior professional, created a platform for rolling up other business services companies. So these are the couple of investments that we made from Fund 2. And as I said, we are looking at four other investments. These are in diverse segments of consumer services, including things like footwear, confectionery, healthy snacks, as well as other related areas.
Okay, that's pretty interesting, some of the areas that you're looking at. But I also understand that the private equity venture capital firms' investments in India fell about 29% in 2022 compared to the record highs that we witnessed in 2021. Given the fact that we still minted a total of 21 unicorn companies, we're far higher than what China as well has seen. What is the outlook on, the emergence of more unicorns? Do you think investors will be a little bit more discerning before putting money to work? And, what's the outlook on how you see the trend for PEVC investing for the year?
I think PEVC investing for this year and for the next few years is going to be reversed. PEVC investing is a function of, as I said, the pools of capital which have already been raised and which have to deploy over the next 3, 4, 5 years. And since that pool of capital is already in place, sooner rather than later they'll have to deploy. The 29% or so decrease that you're talking about is largely in terms of value, I think, and that has happened because late stage new generation technology companies which attracted the biggest checks have failed to do so, or have not done so at the same level at which they were doing last year. And that is something to do with the fact that last year, same time, probably investors thought that these companies are going to have very strong reception in the public markets, and therefore investing in pre-IPO rounds in companies like Zomato, Paytm, Nykaa, Policy Bazaar, and other companies like Pharmacy, etc., which are supposed to go IPO, that attracted a lot of capital. It is a given, and I think that is here to stay, that given the way that these companies have performed in the public markets, the pre-IPO pool of capital is going to be less attracted towards companies of this nature, because now it seems, at least for the near term, that public market investors are not buying the exemption that these companies seek from the scrutiny of quarterly results, and therefore a lot of the plans for some of these companies to go public would have to be put on the back burner. And I think it's also come out in statements made by people like SoftBank, Tiger Global, that they are all going to move slightly more early stage than where they have been. Now, therefore, what it means is that while you will see robust activity in terms of volume, in terms of ticket sizes, I would say that the highs that we saw last year may not be replicated immediately. But having said that, this asset class structurally is a long-term asset class in India. It is bound to grow. Levels of deal activities are going to grow. There are a lot of companies which are going to become unicorns. It was bunched up because we had 100 unicorns in 1 year or so. And then it was bunched up because just the environment where people were willing to give high valuations was present. There was a lot of euphoria. I think some of it was just coming out of COVID, and whenever such a dislocation happens, habit changes get accelerated. People believe that new kinds of winners are going to get created. There was a frenzy to participate in some of them. So we are going to see a more rational world. In summary, I don't think volumes are going to see a dip. You're going to see equal or greater number of deals happening. The quantum of checks, because the late stage funding for tech companies which are looking to IPO is a market that is almost disappeared for now. You're not going to see the same levels of check sizes coming to the fore.
Same level of check sizes. All right, Abhishek, thanks very much for putting all of those details into perspective. Good to have you on Startup Central.
Thank you for having me. Take care. Bye.